Palantir stock lost nearly half its value in 8 months. Not because the business was failing, but because investors decided it was too expensive. Then one earnings report sent it up 29.5% in a single day. Here's why that quarter changed everything. To understand why this print broke the pattern, you need to know the pattern. Palantir peaked at $207.18 in early November 2025. Then the slide began. By late June 2026, the stock had fallen to $107.27, a 48.2% drawdown from that peak. The frustrating part for shareholders was that the business wasn't collapsing. In February, the company reported a strong Q4, and the stock fell 11.6% anyway because valuation concerns overrode the good numbers. There were rallies along the way, including a jump in late May on strong Dell and Snowflake results that reinforced confidence in Palantir's AI partnership with Dell. But the stock kept sliding to new lows. Heading into the Q2 print, it was still roughly 25% below its November peak. Why would a stock fall on good news? Because of what the market was actually pricing. When a stock trades at a very high multiple, investors aren't paying for this quarter's results. They're paying for years of future growth, all pulled forward into today's price. So the bar isn't, did you beat? The bar is, did you beat enough to justify the price? In February, the answer was no, and investors sold. That's the mechanism behind the whole drawdown, not a broken business, but a price that had outrun the story. So the Q2 report, filed August 3rd, had a lot riding on it. The numbers landed hard. Revenue came in at $1.94 billion, up 93% year over year. Adjusted earnings per share were 41 cents, and the company issued the largest increase to annual guidance in its history. CEO Alex Karp called the quarter otherworldly and pointed to demand for AI sovereign tools, AI software for governments, as the driver. The market's response was immediate. The stock was up 16.1% in pre-market trading, and it just kept going. On August 4th, Palantir closed at $162.66, up 29.5% on the day, the largest single-day move in our window. That's a 52% recovery off the June bottom, though it still leaves the stock about 21% below the November peak. So why did this quarter break the pattern? 3 things working together. First, the numbers themselves. Revenue up 93% is a blowout by any standard, but a single strong quarter alone wouldn't have done it. Palantir had strong quarters before and still got sold. What made this different was the second factor. Second, the guidance raise. Guidance is the company's own forecast of what it expects to make in the future. It matters because the market prices stocks on future earnings, not past ones. And guidance is the most direct signal a company gives about that future. When Palantir raised its annual guidance by the largest amount in its history, it was telling investors, the 93% growth isn't a one-quarter fluke. We expect this trajectory to continue. That's powerful, because it removes uncertainty. And when uncertainty drops, the downside risk the market was pricing in, the worst case it had been guessing at, shrinks. A market that has to guess prices the worst case, not the average. By committing to a higher number, Palantir took the guessing out of it. Third, the narrative. Karp's framing, AI sovereignty, governments buying AI tools, gave investors a reason to believe the growth is durable, not cyclical. It's not just we had a good quarter. It's there's a structural wave of government demand for AI, and we're the ones selling it. That's the kind of story that lets a stock re-rate. So the 29.5% surge was the market doing a reset. For 8 months, the question had been, is the growth real and durable enough to justify this price? The quarter, the numbers, the guidance, the narrative answered yes decisively, and the market repriced accordingly. Where it stands now, Palantir closed at $162.66. Roughly 52% above its June bottom, but still about 21% below the November peak. The unresolved question is whether this holds. Palantir's history in this window shows a pattern of sharp post-earnings reversals. Remember, the February drop came the session after a strong Q4. Whether the otherworldly quarter and the record guidance raise can sustain this rally, or whether the same valuation anxiety that drove the 48% drawdown reasserts itself, is still open. Today, the market chose to believe the growth. The next few months will show whether it was right.